Okay, welcome everybody. We are here at the week one of It's Your Estate, week one of 8. My name is Trevor Murphy. I am the CEO president of Financial and Estate Literacy. We are a small nonprofit that executes the It's Your Money and It's Your Estate programming twice a year, which are both 8-week series on financial planning, estate planning, and charitable planning. We do aspire to provide all attendees with practical solutions and education on issues regarding these topics. We want you to be in control and in command of your finances during your life, and also to be prepared for your estate to be prepared for after you pass away. These workshops are a free community resource and service for you. It's education only, and we are selling nothing. All the volunteer professionals, Patrick's here today with us, and you'll see over the course of these 8 weeks in It's Your Estate, a series of attorneys that are going to come in and share their professional experience with us and educate us. But nothing, we are not selling anything, and this is all community education for you. Real quick, I'm going to just go over a couple things. I'm going to share my screen. I'm going to take you to our website. Let's see. So when you get your reminder emails, which you will get 1 week before, one day before your so Wednesday mornings you'll get a 1-day reminder, and then an hour before we start on Thursdays, you will get another reminder with your link. There's also in that email a link to this page, which is the It's Your Estate materials page. There's an It's Your Money materials page and an It's Your Estate materials page. On this page, you will find the presentation handouts each week and the Ask First for the presenters here. And then there will also most likely be some articles shared that Peter Kote, our moderator, has put up for some reading. We strongly recommend that you either have those ready when you are attending these webinars, but and then you can, in your own time, read some of the articles. We will also be posting the recorded webinars on the website. Usually it takes about 24 hours to upload and edit the actual program, but it'll be also here coming soon. So that'll be there probably tomorrow, definitely before the weekend. So if you miss something, or if you miss a week and you want to read it or view it again, or if a topic went by too quickly and you didn't really understand and you want to review it, you can go back and read it there, or see it there. Let's see. Oh, okay. I'm going to stop share for a second and go back. If you have a question, there is a question and answer on your bar at the bottom. There's a question and answer button. I will be fielding those questions and either answering them directly to you and posting so everyone can see, or I may interrupt the presentation or interject at a proper time and pose the question to the speakers. We'll try to get to all questions, but sometimes some slip through, and other times that I know that the topic will be covered in a later week, and I may ask you to tune in then. Let's see if I got all my things here. Okay.
Why don't you go ahead and put the poll up, Trevor?
Sure. Pete, okay. We have a short poll today regarding, we kind of want to see what our audience is made up of. So if you wouldn't mind, there's 4 questions. If you wouldn't mind using your mouse and answering those. Oh, there they go. They're starting. Let me see. Okay. Give you guys some time.
There is 4 questions, so scroll down for number 4.
There are 4 questions. Correct.
And I forgot to put a blank ask first form on the materials page on this one. So
you can find one in the It's Your Money Week one.
Yeah.
Put it there.
And
okay. We're still going. Got it's about 10 people who haven't voted, but I'll just, there we go. So Pete, it's looking like, can you see the results there?
No, I can't.
Can't. Okay, I have to share them, I think. Okay, I'm going to end polling, share results. Okay, here we go. Can you see them now?
Yes, I can.
Okay, so you can see that according to our audience today, we have majority of them are married, which is good, but not a huge majority. You still have a healthy, almost 40% single. Do you currently have a estate plan? It's almost, there's a little, 53% say yes, and 47% say no. So that's a good, almost even balance between those 2 issues. If you have an estate plan, are you currently in need of updating or making changes to your plan? 45% said yes. And 13% say no, and about 42% do not have any documents, Pete, so far. And how old are you? Most of us are 65 and older. That's to be expected, and it's good to see. There are some in the 21%, 50 to 65, 16% in 35 to 50. And it looks like there's one person that's under 35. So in any event, I think, Pete, it says that there's 45% of the people need to make changes to the estate plan. Do you recommend they just go right out and make a change as soon as today is over?
No, no, just every single time you go into an attorney's office, they're going to charge you. So you just want to kind of discuss the changes and ask questions so that when you go in, all your changes can be done at one time. But it's very common because life changes that your estate plan has to change. And many a times people just don't because of the cost to make a change. But it ends up costing you more at the end if you don't keep it up to speed. And we'll talk a little bit as we go through some of the sessions of things that you may want to focus on as far as what changes to make. And it's also very common that many individuals don't have an estate plan, and we'll talk a little bit about that, what happens. And it's one of the reasons why this workshop is in existence. And because in our family, when my dad died, we had no documents whatsoever. And so, and here in Orange County or here in California, without having legal authority to help another individual or to do anything, it leaves you really in a bind. And so it's one of the reasons for this program. It's kind of my catharsis to help other people so that they don't have to go through what we went through.
Yeah, so it's very common that a lot of people die intestate, which is without any documents, and we'll learn. But also just the fact that there's 8 weeks of material, there's a lot to learn, and there's a lot of definitions and vocabulary. So we recommend that attend the 8 weeks, and then once you're equipped with the information, then's a good time to maybe go see an estate planning attorney and make those changes.
Yeah, we're going to go slow.
Yeah.
This is not a speed course, and you're welcome. I know Patrick, if you have tax questions, he will be happy to answer them by email. Trevor, same thing. I'm available as well. This is all about helping you, and hopefully you're giving us your time, and so that's one of the most valuable items that you can possibly give. So you want to get started, Trevor?
Yeah, let me get Pat's. I'm going to get his Ask First form up there for you.
Okay. First of all, Patrick, what's the background on your screen?
Oh, the background here, the virtual background is that's an aerial shot of Cornell University.
Cornell University. And did you go to Cornell?
I did for my MBA.
Wow. Okay. Well, that's the first question on the form is we recommend highly that before you meet with a professional, these are just basic questions that you should know about the individual that you're going to hire, because they're going to be working for you. And especially in the estate planning area, there's lots of workshops out there that an attorney will get together with an insurance agent and offer, quote unquote, a free lunch or a workshop. So we recommend highly, before you hire someone or even interview them, ask them to complete the Ask First form. So first of all, you mentioned that you've got a master's or other advanced degree, Cornell University. How long have you been out of school? You look way too young.
I've been out of school for a while. So I went to USC for undergraduate and graduated there in 2002. And then
in USC, what degree did you get there?
Bachelor's of Science in Business Administration. And the MBA was done, finished in 2010. Okay. So I did a little bit of work between then.
Talk a little bit about what you did when you got out of school, a little bit of your past history before you went into business with Marty.
Yeah, so my background has always been financial planning and tax planning, as well as investment management, and spent 6 years in public accounting, doing tax consulting for high net worth individuals, business owners, and as well as privately held companies.
Okay. Relevant licenses, you still have your CPA designation, but you don't practice in the accounting. You are a financial advisor.
Correct. And so, for us, taxes apply to everything, whether it's financial decisions today, when you die, while you're working. And so a lot of investment decisions revolve around taxes too. And so Marty and I use our tax background in a lot of the tax planning, but we don't practice public accounting anymore. So we don't have a tax season.
Okay. Yeah. Most people think that that you have to have a special skill in the investment world to make investments, but you really don't have a lot of control whether or not there's going to be a worldwide depression, or whether or not there's going to be a war, or there's in the investment world, there are so many areas that you have no control over, but in the tax area, you actually do.
Correct.
And so you try to focus in on that to bring a better return for your clients.
Yeah, and like you said, kind of the way we approach investing too is, broad global diversification. So that's where you're not trying to pick and choose specific companies or sectors that you don't have control over. And so, we focus on what you can control, which is taxes and fees, honestly.
Yeah. So let's get into, you do not practice law, your business relationship, you are a fiduciary to your clients. And I was reading Bernie Madoff just died, I guess, yesterday or the day before. And it seemed like most people that he communicated with directly, they called it affinity groups, the Jewish community that he was very prominent in, and that and he was known as just a wonderful person. And so it's what most people tell me of why they hire a financial advisor, because they're really a good person. They have no idea what fiduciary means. Can you talk just a little bit about what's the difference between you and a broker and you being a fiduciary?
Right. And not to say that, brokers are bad people or anything, but, the business model that we're set up as, we're a registered investment advisor, and that's where we provide investment advice to clients, and we have a legal fiduciary responsibility to those clients. And that means at all times we have to put the client's interests first and above ours. On the flip side, the brokerage model, which I think people may be more familiar with, and the brokerages out there, for example, a Merrill Lynch or a UBS or something like that, they abide by a suitability standard. So not a fiduciary standard, but suitability. And that just means that if you qualify, if you have income over a certain level, or if you have assets over a certain level, an investment or a product might be suitable for you. So therefore they can invest your money in that. It might not necessarily be the best thing for you. And I'll give you an example. So for example, let's say my company, I work for a brokerage, and my company has a S&P 500 index fund. And that makes sense for you because it's a broad index fund of stocks. And the underlying fees on that fund, let's say they're 1%. But Vanguard also has an S&P 500 index fund, and the fees on that fund might be 0.05%. Both funds are suitable for the client, and so the broker could technically put you in the one that's more expensive, where for a registered investment advisor with that fiduciary obligation, they have to put you in the better one or the cheaper one, and they would put you in the Vanguard fund because it's much cheaper for the same strategy.
Yeah. You had mentioned that fees are very, very important when you have a relationship with a financial advisor. How do you charge your clients?
So for us and the way we charge clients, it depends on the service, but the client is always the only person that pays us. And it could be a percentage of the assets that we're managing. And for some clients, we just have a financial planning engagement where we might charge them on an hourly basis. But we're never paid by selling any particular products. We're never paid from fund companies.
So how do you transfer mutual funds, stocks? In other words, who is your broker as far as trades are concerned?
Yeah, so you talked about Bernie Madoff, and that's where kind of our setup.
I think that's a great name for him.
That's where our setups are different, in that registered investment advisors have to have a separate custodian for their client accounts. So for example, our clients will have accounts at Charles Schwab and TD Ameritrade. Both of those custodians don't pay us anything, but they house client accounts. And so the only thing we're allowed to do is we have a limited power of attorney to place trades in a client's account and debit agreed upon fees. So it's not in a sense where, so we have a separate independent third-party custodian where Bernie Madoff was the custodian, the advisor, and everything, which means they can withdraw money, put into different accounts or so, and that's what was going on. And we don't have the power to do that.
Right.
And that's something where if you fire the advisor in a registered investment advisor setup, the advisor gets the power of attorney taken off, and you now have your Schwab or TD Ameritrade account.
Okay. And so you, just to reiterate, we went through a little bit this yesterday. So for some of the people in the audience, this is a repeat, but you have a minimum of, I understand, of $1 million in investable assets.
So we've actually updated our services, and we do have a service level that starts on the investment management side at $500,000.
Okay, great. And then how do you charge?
So it would be a percentage of those assets that we're managing.
And what's that percentage?
So for the $500,000 service, that is, we would use model portfolios. We would start charging it at 0.75% on the assets. And if clients wanted anything, we'll still review tax returns and things like that. But if they wanted financial planning services, that's where we would charge on an hourly basis there. Okay. And that charge can range anywhere from $150 to $420 an hour.
Okay. All right. And are you, if you scroll down just a little bit on the screen there, this is what Bernie Madoff was famous for. He had affiliated organizations. They were called feeders, and they fed clients into his business. And Bernie Madoff paid them to feed clients to him. Do you take any fees from mutual funds, insurance companies, annuities, etc.?
We do not. And, you might hear some of these terms thrown around nowadays, but there's fee only and fee based. And we're a fee only firm. And that just means that, like I said before, the client is the only person paying us. So we get zero commissions on anything.
Yeah. And we're going to go more into fees for financial advisors in the It's Your Money session. And we'll get into each of the presenters in the It's Your Estate session. We'll have an Ask First form, and we'll ask the attorneys what their fees are, how do they charge, etc. Because I find many individuals are hesitant to ask as to exactly how legal fees are paid, and you need to know that up front. So, Patrick, why don't we go to your bio so we can learn a little bit more about you besides just the cold hard facts of the Ask First form?
Yeah,
Okay.
Go ahead and share, Patrick.
Okay. All right.
Go to your bio. There you go.
There we go. So,
I could tell you just got a haircut.
I think it's time to update that picture. I think that picture might be 7 or 8 years old.
Yeah, I think that goes for all of us on our website. Anyway, 18 years experience, counseling, high net worth. Are you married?
I am married, and I met my wife at Cornell, actually.
Oh, really?
And we moved back to Orange County, and we've got 2 little girls. So what you can't see in there is I've got a couple white hairs since that.
How old are the girls?
6 and 4.
How has been the pandemic? For you all, has it been hard?
Well, I've got even more white hair now.
Yeah.
So no, it's been interesting. Obviously anyone with kids knows about virtual schooling and trying to manage that as well as work and everything else. So it's been a challenge.
Unbelievably difficult. Yeah. Okay. So many of the things that we're going to be learning today, we covered some yesterday in the It's Your Money course, but we're going to focus a little bit more on the state side in this particular session. So let's get started, Patrick.
All right. And so today, going back, we're going to provide a tax update and, talk about some of the taxes and how they apply to you as individuals, as well as on the trust and estate side. And, we'll also talk about some of, I'm sure a lot of you are wondering about with the administration change, what some of the potential changes and will be, and then some of the ways we might be able to address some of those changes with planning. So this is just an update. The annual gift tax exclusion, I don't think that's changed for a while. So that just means that you're allowed to give an unlimited amount of people up to $15,000 a year without having to file a gift tax return. And that is one of the potential changes that we'll talk about later.
Yeah, people get so confused on this. So if I gave $200,000 away to my son this year, what would be my estate exemption amount?
Yeah, so the estate and the gift exemption. So the estate exemption is the amount you're allowed to pass during your lifetime to other individuals without having to pay any taxes. And so if you gave someone $200,000, first they take away that $15,000 gift tax exclusion, and then the excess would eat into that estate tax exemption, or the estate and gift tax exemption. So that would be reduced by the balance there.
Yeah, so it would be around 11,500,000.
Correct.
So, all right. And when you're above the estate tax rate, then each dollar gets taxed at 40%.
Yeah, it ramps up, but it ramps up pretty quickly. So you can essentially say 40% is, and that's why managing your gifts and the estate taxes is such a big deal, is because at that point where you're giving away assets that you've worked hard to earn to your kids, if they are subject to estate tax, for every dollar you're giving away, 40% is obviously going to the government and 60% is going to your beneficiaries.
When I was at Long Beach State University and I sat down with many professors to kind of go through their estate plan, one of the first questions I used to ask is, do you understand your net worth? And it was amazing to me how very intelligent individuals could not put together a net worth statement. Mm-hmm. Is that common that you see in your area as well when you're working with clients, that they forget an asset here or there, that if somebody has a life insurance policy of $3 million, is that included in the estate net worth column?
So it depends, and it depends, what type of insurance and if there's a cash value or things like that too. But you're absolutely right. It is important, whether it's prepared by yourself or an advisor, to kind of keep track of your net worth. And a lot of people think about the assets, or they forget they have assets, but they also forget about including the liabilities there on that estate sheet too.
Yeah, it's we're going to learn in the It's Your Money section that putting together a net worth statement is really important. Mm-hmm. So let's go to the next slide.
All right.
Let's spend some time on this one.
Yeah, and that this is, Prop 19 was a big deal, and it changed a lot of, or changed and updated a lot of the prior propositions that applied to real estate. And a big one here is that the first one, and people 55 and over in California can now move and transfer the property tax base of their primary residence up to 3 times in their lifetime. Previously it had been one time, and it really depended on the county that you're moving to. And it most oftentimes there's only a few counties, I think, in California that would allow you to go outside of the county as well. So now this allows you to move anywhere within the state.
Does that mean that let's say you wanted to buy down, but
Mhm.
buying down actually means that the house is going to be more expensive because you want to be closer to the beach or whatever. Is there any other rules that the value has to be similar or lower, or it doesn't make any difference?
Well, now that's something there where if the value it used to be, it had to be less, and now they're allowed to do it regardless. And
Okay.
there are some things that come into play if the value is over $1 million more than the current assessed value. Oops.
Oh, go back.
There we go.
Hey,
So going down a couple of these other items, there have been a lot of natural disasters, from flooding to fires over the past few years. And that's something where you don't have to be 55, but you can transfer your tax rate one time during your lifetime. And this third bullet point, in the past, you could transfer $1 million of other real property. So that's just, say you own a rental property or so, and you wanted to pass that to your kids. And you could pass that to them without reassessment. So for example, if you bought it for $250,000 and it's now worth $2 million, you could pass it to them, and they would be able to keep that property tax base. That has changed. And so now, at the time of the transfer, if the difference between the assessed value and the fair market value exceeds $1 million, so in the example I just gave you, that would be the case, the new assessed value for the beneficiaries would be the fair market value of the property minus $1 million. So in that example where I gave you, where you had a $250,000 base, but the property was worth $2 million, if that was passed to the beneficiaries, their property tax base would now be $1 million. It'd be the 2 minus the $1 million.
Okay.
And then on top of that, the primary residence transfer in the past, parents were able to pass that to kids, and they'd be able to pass on the property tax base. But now there are two conditions that have to be met and able to do that. And one is the primary residence has to be used as the primary residence of the child inheriting the house. And then again, the fair market value cannot exceed the transfers or the parents' assessed value by more than $1 million, or that rule comes into play again.
Patrick, we have a question.
Yes.
And this is posed regarding, someone went to a real estate attorney and they were advised that investment property to heirs can avoid reassessment if placed properties in an LLC. Heirs would be LLC members and thereby not be assessed capital gains property tax, or when other members' parents are deceased. Properties are titled and held in the family currently. Is this feasible?
We have seen that done. And do you know if this was done before? Because a lot of these laws also changed this year after February, essentially. And so there was a big rush to have a lot of people transferring assets to their kids before then. I can't comment on, I'm not sure on the answer, but I could look into it. That's probably better answered by an attorney for the LLC question now that the time period has passed. So I am not certain, but there might be a way to continue doing that.
Yeah, I've been asked, I've had a lot of people ask me in the run up to February 15th, which was the cutoff date, about these things. And there's a lot of other costs. We're going to talk about a step up in cost basis upon the transfer of ownership. And then also, I think a lot of people don't realize that to insure a property that's in an LLC, depending on where it is, might be a lot more than they expect. I've heard that too, but that's just something to think about. Okay, thank you.
And what your property is assessed at does not correlate to what the value of the property is on the market. So
Right.
a lot of people think that their property assessment is equal to real life value in the open market. And that's not the case whatsoever. Sometimes it is, but many a times it is not. So your assessed property value is what we're looking at, right? As far as the 1 million, or is it the appraised value of the property upon death?
Yeah, so the 1 million would be the new fair market value that they're looking at in terms of those limitations.
Yeah. If the other thing too is what I find happens a lot of times is that parents sometimes assume that the child will want to live in the house. And then if you have more than one child, it's hard to divide the house equally and have them both live as their primary residence. So this is a very, very tricky area because let's say if you have 3 children and you're giving the house to one of the children, and the other 2 has to have equal value from the trust. So a lot of times whoever is the trustee has to go out and borrow money to give to the other 2 kids in order for the one person who's going to get the house to be able to have that reassessment. So there's this is not easy to do. And then the other thing too is that talk to your kids whether or not they really do want the house.
That's a good example, Pete. We see that a lot, and parents have the emotional attachment to the house, and oftentimes we see that none of the kids actually want the house, and so it is better upon death to actually sell the house and distribute assets out. Otherwise, like you said, if somebody's net worth is tied up in real estate and they don't have a lot of additional liquid assets, and one kid wants to keep it or so, that's where you get into trouble. How do you buy out that kid or the other kid?
Yeah, taxes just have a real role in dividing an estate and how to do it appropriately. Do you want to talk about the step up in basis here, or do you want to hold off on that on another slide, Patrick?
You know what? I'll talk about it at closer to the end, because okay. I think there's one of the potential changes would be affecting that step up in basis. So now we can cover some of the income tax issues. So here we've got, and many of you are familiar with this, and this is for 2021 as currently written into the law. Here's the tax rates, and you can see the top tax bracket is 37%. And that hits when you're over $523,000 of taxable income as an individual, and $628,000 as a married couple. And to give you some reference, we didn't post the bracket on here, but what's important when you have trusts is managing the taxes there too, because you can see here a married couple hits the 37% rate when their income exceeds $628,000. For a trust,
irrevocable trust you're talking about.
Yes,
right?
For an irrevocable trust that's keeping the money inside the trust and and paying the taxes. They hit the top 37% bracket when income exceeds $13,000. And so that's huge. And so that's where tax management becomes a big piece of it. Because once you cross 13,000, you're paying the 37% tax bracket there.
Yeah. So what happens a lot of times is that attorneys who do not know sometimes a lot about taxes and put together an irrevocable trust for your children. And then the trustee is not aware of the income tax ramifications of managing that asset. And so paying 37% on any earnings over 13,000 is just criminal. And the reason for it, of course, is that dead people can't vote. And so, irrevocable trusts are not very common, and therefore the outrageous tax issues on irrevocable trust.
And, we have two brackets here. We have the ordinary income, and then we have the capital gains income. And capital gains typically apply to investable assets that have appreciated and you sell. So here on the left side, just wanted to cover a couple of items of ordinary income. So most you're familiar with, wages, Social Security, IRA distributions, rental income. So short-term gains, if you hold an asset less than a year and sell it, you pay the ordinary income tax bracket on it. And one thing that a lot of people don't realize is when you have an annuity and that increases in value and you want to sell out of it, that gain is actually not a capital gain. It's taxed as ordinary income. So you're paying the rates over here on the ordinary income side.
So let's say we're going to go through this in the retirement planning session, but I think let's talk about it a little bit here. Income in respect of the decedent.
Mm-hmm.
What does that mean to the beneficiaries of your estate?
And so, for example, like annuities or some of the IRAs or whatnot and pensions, some of these assets, when they pass to the beneficiary still has to pay taxes on that income that comes through.
Ordinary income.
Correct. And so that's a consideration when thinking about how to pass different assets to different beneficiaries as well.
Yeah, it's, I was thinking at Long Beach State University, one of the professors died, and while he was still working and actively working, and he had 6 months worth of wages that came to him. The beneficiary had to pay the income taxes on those wages because it was income in respect of the decedent. Mm-hmm. Had the decedent lived, or had the professor lived, he would have had to pay the tax. Now the beneficiary has to pay those taxes.
Right.
So there's some income tax planning that occurs after a person's death, which is very important. So CPA is very important as part of the team in the estate planning area, not just while you are alive.
Right. And Pete, we talked about this earlier, but you definitely want, especially if you're going to be the trustee of a family member's estate or so, is you want the people that you're working with to have a good understanding of the taxes. Because oftentimes, attorneys might be good at what they're doing, but they might overlook something on the tax side. And, you also on the flip side, you don't want the CPA necessarily giving you all of the legal advice either.
Yes.
And just a refresher on capital gains, most stock investments are going to pay out what's called qualified dividends. And that income from those stock investments gets taxed at the lower capital gains rates. And same thing if you're owning an asset over a year, then it gets taxed at the capital gains rates. And so all things considered, we like capital gains income over ordinary income, but you can't always avoid that.
Yes. you want your portfolio to be capital gains oriented if you can, considering risk tolerance, asset allocation, et cetera, a lot of other factors to consider. What most people don't realize, though, is, again, in a trust, let's say you're a beneficiary of a trust and you are entitled to receive the net income throughout the year. Well, capital gains can be considered ordinary income for purposes of trust distributions. And most accountants that I know are not familiar with that. And most trustees are not familiar with that. So again, it's important when you're involving trust and estates, bring in somebody very knowledgeable, because it's very worthwhile to get that advice.
I have, guys, I have a quick question. Patrick, regarding the capital gains, does this include cryptocurrencies? Do you know if they're held for more than a year? Are they taxed?
So as it's written now, cryptocurrencies are considered an asset in that respect. So they would be taxed at the capital gains rates. Obviously, that's kind of a fluid situation there, and we'll see how the new administration addresses that. But from what we've seen so far, when people have sold cryptocurrency, they've been selling it and recognizing the capital gains tax rates.
Let's go to the next slide.
All right. We probably don't have to spend too much time on this slide, but this is just an update. When you're doing your taxes, you have all of your different sources of income, and then you're either eligible for a standard deduction, which is up top here, the greater of the two, or an itemized deductions. And so itemized deductions, a lot of these limits are the same. As you're all familiar with, taxes that you've paid, there's a $10,000 limit. So in California, a lot of people's property taxes alone exceed that. And that deduction used to be for the combination of property taxes and state income taxes paid. And it still is, but it's capped at $10,000. That is something that potentially might be uncapped with the new administration's changes.
From an estate planning point of view, I see individuals who are in long-term care facilities, board and cares, or have a caregiver at the house to help with the daily chores, that people are not using that caregiving cost as medical expenses.
Yeah,
and
in which they should.
They should. So those are medical expenses, and it's very easy to get over the 7.5% of AGI with caregiving cost.
Right. And that's where, we talk about the trust and estates, but also from an individual standpoint, when people aren't working anymore, managing the AGI or adjusted gross income is important for a lot of different reasons, Medicare, et cetera.
Yeah, it's capital gains is when you don't have to sell an asset and you still part of your net worth. It really helps with AGI. It's a very important concept. I don't see the long-term. You should never buy a long-term care policy because of the fact that there is a very minor tax break that you get for long-term care insurance. So we'll go through that in the It's Your Money session in more detail, but it's usually not a big deduction.
So Pete, just to clarify, you're saying don't buy a long-term care policy for the tax breaks.
Well, there's a yeah, but Patrick has probably heard this 100 times, but don't let the tax tail wag the investment dog.
Right.
What basically means just because you get a tax break does not mean that it makes a good investment or it's a good idea.
Yeah. And one other thing, in the past couple of years, this gifts to charity has been increased. It used to be 50%, but now you can take a deduction for up to 60% of your gross income.
Yeah, I always wonder whether or not whether or not the tax issues drive charitable donations, or whether it is the mission of the organization. By the way, while we're just have the charity, we're totally sponsored by charitable organizations. And we believe in the philosophy that it's really good to give. The more you focus on yourself, the more paranoid and schizophrenic you become. It's good to think about other people. And there's always somebody in worse shape than you out there that makes you, I think, a little bit more humble, and pleased that you're doing well. But we encourage people to give to charity. And in that regard, in each of the sessions for the next 8 weeks, we will have a charitable sponsor talking a little bit about that particular charity as to what their mission is all about. So just want to throw that in. You will get a kind of a commercial from a charity just to expose you to what these different missions are. And we want to encourage you to make gifts to charity.
All right.
Let's go to the next slide.
Okay, so just to cover a couple more things on the tax rates. There is an additional tax on investment income that's been in play for a while, and that's this 3.8% net investment income tax. And so if you're single and your gross income is over 200,000, or if you're married and your gross income is over 250,000, on those dividends, on the capital gains, you pay an extra 3.8% net investment income tax. So that's where the managing the gross income comes into play. And then finally in California, if you make over $1 million, essentially your top tax bracket is 13.3%. Combined with federal, that would put you over 50%. And that's something where California does not have a difference between capital gains and ordinary income taxes. It's the same rate throughout all.
Yeah, it's also, you know, we talked about AGI, whether or not your Social Security gets taxed. From the investment point of view, you know, whether or not you do tax-free type of bonds, or what kind of, it makes a huge difference in what you get to keep in your pocket as far as taxes is concerned. And most people forget about the California state income tax because it's not really discussed a lot. But you can get up to $60,000 worth of earnings, and you're at between the 8 and 10% rate as far as your taxes are concerned. And I guess I read every day in the newspaper that people are moving to other states because of the state income taxes. So, and if you move to Nevada or Washington or whatever, let's say, and you get a pension from the state of California, it does not get taxed if you're a resident of another state. Let's move on.
Okay. And so there have been quite a few different acts passed in the past couple of years, and with the last administration as well. I'll just cover some of the provisions that are still in effect or that will affect people today. You know, the big one was that required minimum distributions for IRAs started age 72. In the past, at age 70 and a half, you were required to take distributions from your IRA, whether you needed them or not, and that's now age 72. A big one is when somebody passes away, paying attention to the beneficiaries of their retirement account is important too. You can pass your IRA to your spouse, and they can essentially treat it as their IRA or roll it into their IRA. Now, if you pass it to anybody other than your spouse, that entire IRA has to be emptied out in 10 years. And for those IRAs, the majority of them are pre-tax monies, which means all of that money has never been taxed before. So that's something to think about, is if you pass $1 million IRA to your kid, he has 10 years to essentially take that income out or take the $1 million out, but all of that's going to be taxable. So the beneficiary will have to think about tax planning too. Do you take it all at once, or do you spread that out, or things like that too?
In the charitable session that we have, and also the retirement planning session, we're going to go into much more detail on this, but you can actually leave your IRA account into a charitable trust.
Mm-hmm.
And then that charitable trust can give income from that charitable trust for the life of the beneficiaries. So that makes it a little bit more of a unique opportunity if you have problems that 10 years becomes an issue to withdraw. So that creates another possibility. By the way, one of the things that we try to do in these sessions is to not make recommendations of a particular strategy, but to make you aware of the different strategies so that you could take a look at them to see whether or not they fit with your goals and objectives. Mm-hmm. No one plan is good for everyone, and no one plan just has advantages and not disadvantages. And so the hope is that we're presenting opportunities to you so that you can meet with a professional, talk about what are the advantages for you, what are the disadvantages, so then you can make a choice as to what strategy you want to use.
All right. So Pete, I don't know if you want to cover anything on this slide. This is more applicable to, I think, the It's Your Money and individuals, but it's just some updates on child tax credits and payments.
Yeah, I think we could just move on.
And so I'm not a fan of putting a lot of text on slides, but there have been a lot of potential income tax changes that have been discussed. So maybe we can cover some of the more important ones.
Patrick,
yes?
Pete, just giving you guys a heads up. We got 30 minutes left.
Okay, great.
Okay,
thank you, Trevor.
So when we look at all the potential tax changes, I think the common theme that we've heard throughout the media too is that the current administration is looking to increase taxes on people earning more than $400,000, and then even more so on people earning more than $1 million. They've said that people earning less than 400 shouldn't see an increase in taxes. So we'll have to see there. Some of the big changes, the top marginal tax bracket that we went over before for income is now is potentially going to move up to 39.6%, which was the top tax rate before the Trump administration passed those acts. We talked about capital gains. This is a big one. So the capital gains rates, the top tax bracket there is 20% versus 37% on the ordinary income. So one of the proposals is to eliminate capital gains rates for those with income over $1 million. And so that's something where if you're selling a business, a lot of investments or whatnot, if your capital gain and your income exceeds $1 million, instead of paying 20% on that gain, you're now potentially going to be paying 37 or 39.6% on the federal side of that.
Yeah, here's another opportunity possibly for using a charitable remainder trust, because a charitable remainder trust doesn't pay any taxes, in possible strategy of how to transfer a business tax-wise.
Yeah, and there's a lot of, it's all speculation right now, so we'll see, but hopefully we'll know soon whether these changes go into effect for 2022 and what changes go into effect. And hopefully they don't do it retroactive and have it effective 2021. Somebody earlier asked the question about cryptocurrency and selling it. And so one of the potential planning opportunities is if they do raise the tax brackets up, depending on how much cryptocurrency you have, And let's just say in 2022, they say capital gains rates for those above with income above $1 million is taxed at ordinary income rates. That might be something, if we find out that the laws are changing that way and you have a huge position of cryptocurrency, you might consider selling it in 2021 at the lower capital gains rates versus paying almost 20% more in 2022. But that's to be determined with any of these changes here.
Yeah. And by the way, look at the first word on the screen there. These are potential.
Yeah.
Nobody knows how the chef in the kitchen is actually going to serve the meal, with all the different ingredients that goes into making laws. So these are just things that are being talked about in the media. They're going to be subject to compromises. Nobody wants to pay more taxes. You're going to get lots of media saying, we shouldn't increase taxes. So we'll see what happens, but move cautiously before you make any changes based on potential income tax changes.
Yeah, thanks, Pete. Yeah, we want to clarify, we're not providing tax advice today. These are just things to think about. And, if you're thinking about selling certain things or making actions, you can just kind of start thinking about how you might want to do that if laws change.
Yes.
But I wouldn't take any actions until anything's written into law either. One of the other big ones is Section 1031, the tax-free exchange of real estate. I
don't think it'll ever happen.
They might eliminate that. So basically, you can't exchange into another property, and you have to pay all the taxes at once.
Yeah.
Reducing.
I think you'll have every apartment owner marching on Washington if that was the case.
Limiting the itemized deduction cap at 28%. So while they're saying that they might take off the property tax and mortgage interest limits, they might say, okay, you can do that, but we're also going to cap the itemized deductions at 28% of your income too. So
all of these things are for negotiations on the Hill. So this is just their first salvo.
Yep. And then, limiting the size of retirement accounts and IRAs. They don't want people to have too much in their retirement accounts, I guess. And so that's one where they could potentially assess additional taxes or penalties by having an account that's too big. I don't know about that one, if that'll pass. That's got to be that doesn't sound right, because you're punishing someone essentially for growing their account.
Yeah. Do you think Roth IRAs are underutilized by individuals in the estate planning area?
They are, and we'll address that on the next slide too, because I do have a comment about that.
Okay.
And let's see. So we can actually move to the next slide. So actually, I think it'll be the following slide. But here's some potential estate tax changes. Pete, you talked about the step up in cost basis at death. What is that? And what that is we'll go back to that house example I gave you, where
why don't we use stock, a $10 stock that you purchased it for and you sold it for $110.
Okay. So if you buy a stock at $10 and it's now worth $100, you don't pay tax on that until you sell it. But if you were to sell it, you've got a gain of $90,000 because that stock is appreciated by, a gain of $90 because that stock is appreciated by $90. Right now, as the law is currently written, your capital assets upon death get a step up in cost basis. And what that means is if I bought a stock for $10, it's now worth $100. I pass that to my kids. Now they have that stock, which is worth $100. If they sell it tomorrow, they pay zero taxes because that cost basis of $10 got stepped up to the fair market value on the date of death. And so the cost basis that they now have is $100. So it's the fair market value. And that's why it's important too with highly appreciated assets to think about, especially as you get older, do I want to sell this right now, or do we wait, and is this something that we pass to our kids because there's all of this gain that they're not going to have to pay taxes on at all. One of the potential changes is they would eliminate the cost basis step up, which would be huge because that's a lot of taxes, especially on real estate and investments that people wouldn't get the benefit of the cost basis step up.
What is a carryover basis?
Yeah, so if they were to use the carryover basis instead, basically that $100 stock that gets transferred to kids, they still don't pay any taxes until they sell it, but their cost basis is the same as the parents. So it'd be that $10. So if they do sell it, then they pay taxes on that gain of $90.
By the way, is this that your carryover basis is what happens if you were to gift that stock today?
Correct.
So if you were to give that stock to one of your children, and their cost basis is going to be exactly what you paid for it, and they would have to pay a capital gains tax when they sell it based on that cost basis of $10. So yeah, this is just huge as far as what I consider most of us, if they eliminate the cost basis, step up at death benefit.
Yeah, because right now it definitely benefits the beneficiaries to receive something through will or trust when somebody passes versus being given something outright, just because you're essentially getting a free appreciation and not having to pay any taxes on that.
Right. It's one of the reasons why when we start with an estate planning process in the administration of it, we normally do sell the assets if they have a portfolio of stocks and bonds, because there's no tax ramifications. And then each beneficiary can invest that monies based on their goals and objectives, and not on the parents' goals and objectives when they had the stock, because all of a sudden tax is not an issue.
Right. Another big one, the estate tax exemption. We talked about being able to pass $11.7 million to people or beneficiaries over your lifetime, or through transfer. And they're talking about reducing that. They probably will reduce it. But
well, it's going to be reduced if they leave the law the way it is, just because of the sunset clause.
And they're talking about $5 million or less. And so again, with kind of some of the tax things, is don't make any changes yet, because we don't know what's going to happen. And then, honestly, the next administration will probably change it to a different amount. So increasing the estate tax rates from 40 to 75% on large estates. So that would make estate planning even more important, is trying to avoid or minimize those estate taxes there.
Yeah. Yeah. And the estate tax, by the way, if you do some proper planning, it should be zero. And in fact, even when they had the prior law, the estates that paid the most in taxes were the estates where no planning occurred. So it's just incumbent upon, if you have a large estate, to do some planning, because all of those taxes can be eliminated through charitable stuff, through different kinds of trust, et cetera. And we'll learn some of those in the 8 weeks.
Yeah, and right here, Pete, the reducing or eliminating discounting techniques, you talk about like giving assets. So for those of you not familiar, there's ways to pass assets, especially illiquid assets like real estate or business interests or whatnot, while you're still living, to trusts for your kids, and doing that on a discounted basis. So for example, you have a $10 million piece of property. There are ways to discount it where you pass, or a business interest, where you pass it to your kids, and they put the value at, say, $4 million. And that's important because that $4 million would eat up some of this $11.7 million here. And so there's ways to kind of pass more of your assets by discounting their value in doing that. And so they're talking about reducing or eliminating some of those techniques. And then I guess eliminate federal estate taxes and recognize all capital gains at death is also something they're talking about. So I guess that would be a little bit different. I guess there'd be no step up, no estate taxes, but then you just pay taxes on the gains on everything. And then the last one is kind of reducing. I talked about giving $15,000 per year to unlimited donees. One of the proposals is to cap the amount of the exclusion that you could be used for the whole year total. So you might only be able to give up to $50,000 total to all people, and anything over that would eat at that exemption.
All right.
And so here's some of the plans.
I'm sorry, Patrick. Trevor, how are we doing on time?
We've got 17 minutes.
Okay, and counting.
This is the last slide, Pete.
Okay.
We talked about some of the potential changes, and here's some considerations that to start thinking about. So we talked about charitable contributions. One thought might be, as much as Pete might not want to hear this one, is to defer charitable contributions for a larger benefit if rates do increase. So if you're someone who likes to give at the end of the year to your favorite charities or something, that might be something where maybe you give a little bit less and then you can give more on January 1st or so. That would be something to think about. Qualified charitable distributions. So this is a big one here. And this helps with managing that your AGI or your gross income, because we talked about that's very important for Social Security, for Medicare, et cetera. And if you're going to give to charity and you don't need, I guess you don't need the distributions from your IRA, if you're 70 and a half or above, you can give up to $100,000 per year directly to charities. And so you don't get the deduction, but you also don't recognize that $100,000 as income. And so that keeps your gross income low for purposes of Medicare and Social Security.
Yeah. If you're going to give monies to charity and you're over 70 and a half, give it from your IRA. There's got to be, that's almost a flat out rule that's a benefit for you, no matter what income tax bracket you're in.
And that did not change with the RMD change in 2019. So that's still 70 and a half, not 72. All right. And then we talked about, Pete, you asked a question about Roth IRA conversions and why you might want to do that. And so if they're going to raise taxes in 2022 and above, you might consider doing a larger Roth IRA conversion in this year. And the way that works is you take an IRA distribution from your IRA and you pay taxes on it today. So you'd be paying taxes at a lower rate today. And then you convert that and you move that money into a Roth IRA. And the difference between a Roth IRA and a regular IRA is all of the growth in that Roth IRA is 100% tax-free. So if that's something that you're planning on giving to your kids, that's much better that they can receive an asset that's going to appreciate and be 100% tax-free. And even if they have to take it down in 10 years or so, it's all tax-free.
I'm amazed that the Roth IRA still exists. It is so amazing.
I got a question regarding a qualified charitable distribution. Does the qualified charitable distribution work for RMD from an inherited IRA too?
It does not work for inherited IRAs. That's my understanding.
Yeah, it's mine too. But
All right.
We'll find out in the charitable section. Don and we'll be talking about it.
There's one more question. Does the Roth conversion apply for someone who no longer has regular income?
Yes, so you can do that. You don't have to be working anymore to take advantage of that.
Take a look at it. It's pretty nice.
Yeah.
Go ahead.
Okay, and then to another note on the crypto question and selling too is if they are going to raise rates, depending on if they raise capital gains rates or if they raise or whatnot, there's accelerating gains and defer lost harvesting. And so that might be something where you were going to sell something anyway, and maybe you were going to sell it in the next year or two, you might consider potentially taking advantage of lower rates today versus potentially higher rates next year. Again, I guess we'll wait and see what those rates are. And then, sorry, as far as estate taxes, that was when we talked about with the discounting, and that's trying to plan and take advantage of the larger estate exemption, because if that does get changed and gets brought down to $5 million or even $3 million, that's going to put a lot of people subject to estate taxes. So you want to think about ways where you can minimize or eliminate that. And that would be something you'd speak with your estate planning attorney about too.
Yeah, but not anytime soon.
Yeah.
Wait till we get some clarification on this before you do anything. Is that it, Patrick?
That is all I have.
Okay,
and,
stick around. I don't want you to leave in case that you want to provide some input or somebody else has a question. We have approximately, 10 minutes left, Trevor? You're my timer.
Yes, sir.
Okay, don't call me sir.
Feel free, people can feel free to shoot us over emails if you have questions that we can answer on anything that was presented or so.
Thank you, Patrick. Appreciate it. Excellent, by the way. And it's always good to review this over and over again. A little bit more sticks with you when you hear it again. So
Pat, go ahead and stop sharing, please, if you don't mind.
Okay.
I included some articles in the with this particular session. One of the first ones is people inherited fortunes but spent it all. One of the things that I encourage people to do is provide your beneficiaries with a financial advisor, a fee-only financial advisor, because getting a large sum of money, it's like winning the lottery. And if you read anything about lottery winners, many of them are very unhappy, and they don't know who their friends are, and etc. And in other words, they're not better off afterwards. And so that's why I included that article in there, because as parents, you want to do the best for your children. And that's the other reason why I included the article at the bottom. It says a formula for happiness. Leaving a ton of money to heir is not a formula for happiness. So we equate money with love. And so money becomes just a huge issue within families. Dear Mom and Dad, this article was written in 1995, and it's still relevant today. People have just a very difficult time to talk about death, to talk about incapacity, to talk about money within a family. And I used to think that it was Mom and Dad that had the difficult time to discuss. and I totally have changed my mind. I think it's the children that have a hard time believing that mom and dad may not be here. And so you need to bring that up and discuss it. Especially, we've got 53%, I believe, on the poll that said they've not put together an estate plan. That means is that who's going to be there to tell the doctor as to what to do if you can't communicate to your to the physician, or if there's a disagreement within the family as to what to do. So next week, I think it's one of the most important sessions, and that is talking about incapacity. What happens if you suffer a stroke or Parkinson's or Alzheimer's? Who's there to take care of you beyond just the money? The next article that's listed there, the step up in basis, that goes through the step up in basis rule that Patrick discussed. So it's actually written down. How to start a conversation about estate planning. It falls in line that a conversation is important. And somebody just had put up a comment about the movie. I really do care. I think it's a wonderful movie because it shows of what fear is out there about somebody stepping in when you no longer can control your own finances. So it's up to you. You're in charge. We used to have our website used to be Feel in Control, and we changed it only because people thought it was a psychiatrist website. So we're not
sobriety. It was a sobriety website. Everyone.
Yeah, it's a sobriety website. But the whole idea is that you get to choose how you die, where you die, who's in charge if you can't communicate. But this can't happen unless you have the legal authority given to someone else, and you trust that individual to do what you would like them to do. So we're hoping next week that you're there, because it's one of the most important sessions of the 8 weeks. Anything else that you want to add, Trevor?
No, I did have a question just regarding finding the materials on the web page. I was wondering if I could just go through that real quick one more time.
Okay.
So what I'm going to do is I'm going to go back to, like, let's say you came in not through the link you got on your on your reminder email, but let's say you came directly to the website here. If you go to the workshops or this educate, either one, you click on that, okay, and then you'll see all these buttons here, okay, and these buttons will take you directly to the sort of series. But if you want the materials, you see down here, there's schedule, register, how to watch materials. Click on that, and then click on the series that you're looking for, the It's Your Estate in this case, and you will it'll get you that page where we were at the beginning of the session. And like I said, on your reminder emails, there's a link that takes you directly to this page. But if if you're having problems or remembering this, remember we are going to be posting this recorded session, so you can go back and follow these instructions again. And
there's many more articles on the website.
Yeah, exactly. So I mean, if you go back to the workshops and let's say click on It's Your Estate, and it kind of goes through week by week here on the left. what we go through. This is the presentation from last year, but you can see there's documents and videos and everything per week that we try to keep current. Sometimes the links expire, but for the most part, it's good supplemental material for the sort of concepts we're doing. Next week, we'll be doing estate planning basics. Pete, you want to do a little overview about what to expect there?
The estate planning basics that we're going to be talking about is even those individuals who don't have an estate plan. Well, you do have an estate plan, but it's done by the state of California. So we'll talk about that. We'll talk about what probate is. We'll talk about title. If you can put together a sheet of listing all your assets and now you have title, it becomes so important because title will determine how your assets are going to pass. So we'll go into that in lots of detail. We'll go through an overview of the rest of the 6 weeks of the class. And then the following week, we're going to do the incapacity session. So thanks for the reminder. So next week is absolutely important as to get a good overview of the entire course.
Great. Okay. Well, thank you very much, gentlemen.
Thank you, Patrick.
Yeah, thank you, Patrick.
Thanks, Peter and Trevor.
Thanks for sticking around. Like I said, we will see you next week. For those of you doing the It's Your Money, we'll see you on Wednesday. And if you're doing the It's Your Estate only, we'll see you on Thursday. But have a great weekend and stay safe. Bye-bye.